Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today we're diving into an investment strategy with a track record that stretches back for centuries. And what's really fascinating is its ability to thrive, especially when markets are in total chaos. It's called trend following. So let's start with a problem that, every long-term investor knows all too well. We're talking about the pain of the traditional portfolio. If you've ever put money in the stock market, this chart probably looks painfully familiar. It's a total roller coaster. Just look at those steep red areas. Those are the gut-wrenching drops that investors had to live through during the tech bust and again in the 2008 financial crisis. It is a wild and often really painful ride. Right, so we're always told, just hang in there, buy and hold, the market always comes back. But man, those deep losses are tough, and they can take years, sometimes many years, to recover from. It really makes you wonder, is there another way to get through these turbulent times? Well, the answer might just lie in a beautifully simple, almost counterintuitive idea that really goes against a lot of the conventional wisdom we hear all the time. This little gem of advice comes from the legendary economist David Ricardo. And get this, he said it nearly 200 years ago. It's the absolute core, the beating heart of an investment style we now call trend following. Now, here's the crucial part. Trend following is not about predicting the future. There are no crystal balls involved here. It's a purely reactive strategy. It simply looks at what the market is actually doing, what prices are telling us, and then it acts on that information. So think of it like this. Instead of the buy and hold on for dear life approach, trend followers buy and ride the trend up. But, and this is critical, the moment that trend starts to bend and break, they get out. It's a really dynamic approach that adapts to whatever's happening across all kinds of markets. We're talking stocks, bonds, currencies, you name it. Okay, so it sounds good in theory, right? But does this simple idea actually work in practice? Well, the historical evidence is surprisingly deep and, frankly, pretty incredible. We're talking about everything from the famous tulip bubble back in the 1600s all the way to the huge financial crises of our lifetime, like in 2008. Time and time again, this strategy has shown this remarkable ability to perform when traditional investments are getting hammered. This slide just says it all, doesn't it? On the left, you've got the market absolutely plummeting during the 1929 Wall Street crash. But just look at the right. That's what a trend-following strategy was doing during the exact same time. While the stock market lost about half its value, this strategy returned roughly 90%. Incredible. And what's just mind-blowing here is the sheer scale of the data. This graph tracks a representative trend-following portfolio all the way back to the year 1300. You can see how it consistently generated returns through over 7 centuries of wars, famines, industrial revolutions, and financial panics. So how does all this historical performance translate into a powerful tool for a modern portfolio? What's the secret sauce here that makes it thrive in chaos? So check this out. This chart shows something insiders call the CTA smile. And CTA is just the technical name for many trend-following funds. Notice how their performance is highest during the absolute worst and the absolute best times for the stock market. Why? Because the strategy thrives on big, decisive moves. It can make money when things are going way down just as easily as when they're going way up. You could say volatility is its best friend. This unique performance profile, this smile, raises a really, really important question for any investor trying to build a portfolio that can actually last. And here is the answer. That red line, that's our old friend, the S&P 500 roller coaster. The blue line is the trend-following index. But the real magic, that's the green line. It's a simple 50-50 combination of the two. Look at how much smoother that ride is. It just shields the portfolio from those terrifying peaks and valleys. And the numbers, well, they really back this up. The Sharpe ratio, which is basically a measure of your return for every bit of risk you take, it nearly doubles. But here's the big one for me. Look at the maximum drawdown. That's the biggest loss from a peak you would have suffered. It gets slashed from a painful 51% drop to a much more manageable 22%. Let me put that in perspective for you. That's a 57% reduction in your portfolio's worst-case scenario over this 20-year period. The deepest valley for this combined portfolio was less than half of what stock-only investors had to suffer through. All right, so after sifting through centuries of data, what does this all really mean for you and your investments? Let's break down the key takeaways. The big idea here is that trend following isn't supposed to replace your traditional investments. Not at all. It's meant to complement them. It acts as this powerful diversifier, and historically, it has delivered what people call crisis alpha. That's a fancy way of saying it makes positive returns when markets are tanking. By doing that, it can really smooth out your portfolio's ride and boost its overall risk-adjusted returns. So, this whole exploration leaves us with one final, kind of provocative thought. We all spend a lot of time getting our portfolios ready for the good times, for the calm seas. But this centuries-old strategy forces us to ask a different question. Is your portfolio truly built to weather the inevitable storm?
Let's talk about a powerful investing strategy, one that's been proven over literally hundreds of years. And here's the weird part. It is this strange, almost symbiotic relationship with market chaos.
You know, every investor, from a total beginner to a seasoned pro, we all share one deep-seated fear: the crash, right? That sudden stomach-churning moment when the market just falls off a cliff, erasing fortunes overnight. It's the ultimate nightmare scenario.
But what if we looked at this completely backwards? What if all that panic, that sheer volatility, wasn't something to be afraid of, but was actually an opportunity to be seized? The data on this tells a pretty fascinating story.
Now, the answer here isn't some complicated new algorithm or the latest Wall Street invention. Actually, it's an idea that's been proven over centuries. It's a timeless piece of wisdom for navigating the absolute storms of the market.
It really all comes down to this single, elegant principle from the legendary political economist David Ricardo. Cut short your losses and let your profits run on. I mean, it sounds simple, right? Almost too simple. But this one idea is the engine behind one of the most resilient investment strategies ever documented.
So this strategy, it has a name. It's called trend following. And it does exactly what it says on the tin. It doesn't try to predict the future. It simply identifies a trend that's already happening and rides it. Doesn't matter if it's going up or down.
Okay, so let's look at the hard data, because this is where it gets wild. Researchers modeled this strategy against a traditional buy-and-hold portfolio using 800 years of financial history. The results are just stunning. Trend following almost tripled the average annual return, with only a tiny bit more volatility. And look at that Sharpe ratio. That's just a way of measuring how much return you get for the risk you take. It's more than double. That tells you it's a much, much more efficient strategy.
And this chart, wow, this just puts it all into perspective. This shows the cumulative performance of that trend-following portfolio all the way back to the year 1300. And no, that is not a typo. The y-axis, it's a log scale, which is literally the only way to fit this kind of relentless growth onto a single chart. It just keeps on climbing through wars, famines, financial crises, you name it.
But here is where it gets really, really compelling. Let's dig into the strategy's most counterintuitive feature: its uncanny ability to thrive when pretty much everyone else is panicking.
Let's take the infamous Dutch tulip bubble. A trend follower would have bought into the mania as prices were soaring. But, and this is the crucial part, the second that trend reversed, the strategy would have sold, locking in the profits. This really highlights a key idea. For a trend follower, getting out is often way more important than getting in.
Now let's look at the Great Depression. In October 1929, the Dow Jones lost nearly half its value. It was absolute carnage. So what did the trend-following portfolio do? Well, according to the model, it actually posted a small positive gain. Let that sink in. While the world's financial system was literally collapsing, this strategy was profitable.
And you can see it right here. On the left, the market is just in an absolute free fall. On the right, the trend-following portfolio is climbing steadily upward, right through the middle of the crash. It didn't just survive, it actually prospered.
And you have to understand, this wasn't some kind of fluke. It's not a one-off. The research shows that this crisis performance is a core, repeatable feature of the strategy. When stocks and bonds have their worst months, trend following, on average, does well.
So how does this actually work, right? What is the mechanism that allows it to profit from these massive market swings? Well, it all comes down to a really cool concept that traders call the CTA smile.
So first, we need to understand something called market divergence. It's just a fancy term for periods when markets make big, decisive moves. It doesn't matter if the move is up or down. What matters is that there's a strong, clear trend to follow.
And this chart, this is the smile. Basically, it sorts all market returns into 5 buckets, from the absolute worst on the left to the very best on the right. And notice where the trend-following strategy makes the most money? At the extremes. It performs best when the market is either soaring or crashing. It thrives on what we just called market divergence.
And that, right there, is the fundamental difference in thinking. A traditional buy-and-hold investor, well, they fear volatility. Big swings are a source of stress and risk. But for a trend follower, those same big swings, that divergence, that's the very source of their opportunity.
So, this all leads to a pretty fundamental rethinking of what risk really means for an investor, and, how to build a truly diversified portfolio. Okay, look at this number, 0.05. What does that mean? It's the correlation between trend following and the stock market over the long haul. A correlation of 1 means they move in perfect lockstep. A correlation of 0 means there's no relationship at all. So 0.05, that is practically 0.
And what about the bond market? Well, it's pretty much the same story, just 0.09. I mean, this is basically the holy grail of portfolio diversification.
What this tells us is that trend following truly marches to the beat of its own drum. Its returns are generated by totally different factors than stocks and bonds. And so adding it to a traditional portfolio provides this incredible layer of protection, precisely because it just doesn't move with the rest of the market.
Okay, one last big idea here. It's a bit of jargon, but stick with me. It's called positive skewness. Think of it this way. Stocks tend to climb a staircase of small gains, but every once in a while they take an elevator straight down in a crash. Trend following is the opposite. That cut your losses rule means it takes lots of small steps down, but the let your profits run rule means it occasionally catches a rocket ship straight up. It's a system designed to avoid those catastrophic elevator drops.
So we'll end with this question for you to think about. If your main goal isn't just to make money, but to survive the inevitable financial storms that will come, then what is real risk? Is it the modest, day-to-day volatility of an independent strategy, or is it the hidden risk of a portfolio that looks safe right up until the day it isn't?
Let's talk about an idea that connects a farmer from the 1800s to the 2008 financial crisis. It's a system that quietly shapes everything, from the price of your coffee to the fuel in your car. We're diving into the world of futures markets. It all kicks off with a really simple question, one that farmers have faced for centuries. Let's say you're a farmer. You've got acres of corn in the ground, but you won't be able to sell it for months. You have absolutely no idea what the price will be then. So how do you agree on a fair price for your crops today for a harvest that's way off in the future? For a long time, the solution was pretty basic. It was all built on a simple promise, a direct deal between two people about something that would happen later on. Now, this simple promise has an official name. It's called a forward contract. But honestly, you can just think of it as a handshake deal. You and I agree that in, say, 3 months, I'll sell you something for a price we lock in right now. No cash changes hands today. It's all based on a promise. The timeline for this is about as straightforward as it gets. Right now, at time 0, we make the agreement. Then, time passes, and later, at time t, we settle up. The goods finally get exchanged for the cash at that price we agreed on way back at the beginning. So let's put some numbers to this. A farmer and maybe a big food company make a forward contract. 10,000 bushels of corn. Delivery in 3 months. The price is locked in at $4.50 a bushel. Both the farmer and the company can now plan their budgets. Everything seems sorted out. Problem solved, right? Not so fast. Turns out that simple handshake deal, that basic promise, is actually packed with some serious risks. Let's jump forward 3 months and see what happens. And here is the giant problem. Nobody has a crystal ball. Nobody knows what the actual price of corn will be in 3 months. So if the price shoots up to $6, the buyer is ecstatic. They're getting a massive discount. But the farmer? They're forced to sell way below market value. But if the price tanks to $3, the tables are turned. Now the farmer's the one who's happy, and the buyer is stuck paying way too much. No matter what happens, one person wins big, and the other person loses big. And that winner-loser setup creates the first huge problem. Counterparty risk. It's a fancy name for a very simple fear. What if the person losing the bet just walks away? I mean, if the price collapses, what's to stop the buyer from just vanishing, leaving the farmer high and dry with a barn full of corn? It's a massive risk. Then there's problem number 2, liquidity risk. These deals are totally custom, made just between two people. So what happens if the buyer's situation changes and they don't even need the corn anymore? Well, they can't just sell this unique, specific contract to somebody else. They are completely stuck. The deal is totally illiquid. It's frozen in place. Okay, so these were huge, fundamental problems for business. So, in the middle of the 19th century, a brilliant innovation came along that was designed to fix all of this. And we're not talking about a little tweak here. This was a complete revolution. In 1848, the Chicago Board of Trade was founded, and with it came the modern futures contract, an invention specifically created to solve the problems of that old, risky handshake deal. And that really gets to the core of it. The whole reason futures contracts were invented was to eliminate those two giant headaches, the risk of someone bailing on you and the risk of being stuck in a deal you can't get out of. But the big question is, how did they do it? All right, so let's pop the hood and see how this new, trustworthy system was actually built. It all boils down to three really clever ideas. First, standardization. No more custom one-off deals. Now, all contracts are for the same amount and the same quality, like 5,000 bushels of number 2 yellow corn. This makes them totally interchangeable, almost like dollar bills. Second, and this is a game changer, the clearinghouse. This is a central middleman that sits in between every single buyer and seller. You don't have a deal with another person anymore. Your deal is with the clearinghouse, and they guarantee it. And third, margin accounts. Think of this like a security deposit. Everybody has to put some cash up front as a good faith deposit. This money is then used to cover wins and losses every single day. If the market goes against you, a little money comes out of your account. If it goes your way, money goes in. It prevents anyone from getting into a huge hole they can't climb out of. So you combine those three things, and what do you get? Well, you get a market that's transparent because everybody's trading the exact same thing. Counterparty risk? It's basically gone, thanks to the clearinghouse and those daily payments. And the market becomes super liquid because these standard contracts are a piece of cake to buy and sell. The old problems? Poof, they're solved. Now, you might be thinking, okay, that's a neat piece of history from the 1800s, but the crazy thing is, this invention is probably more important right now than it has ever been. Because think about it, when the 2008 financial crisis blew up, investigators started digging through the wreckage. And what they found was that a huge part of the modern financial system was built on products that looked an awful lot like those old broken forward contracts. They were custom, secret deals between two parties with a terrifying amount of counterparty risk hidden just below the surface. Sound familiar? So what was the fix that regulators came up with? A process they call futurization. It's pretty much exactly what it sounds like. It's the process of taking all those risky backroom deals and forcing them to become more like futures. Standardized, centrally cleared, and out in the open. You can see exactly how it played out right here. The crisis exposed all these hidden risks in the system. That led directly to new laws and regulations. And what did those rules do? They forced the financial world to adopt that safer, more transparent model, the very one that was pioneered by the futures markets over a century and a half ago. And the sheer scale of this change is just staggering. Just a few years after the crisis, by 2013, funds that specialized in these kinds of markets had ballooned to over $330 billion in assets. We're not talking about some tiny corner of the market. This is now a core pillar of global finance. So let's just wrap our heads around this. An elegant solution, designed in the 1840s to solve a farmer's problem, became the essential blueprint for fixing the entire 21st century financial system. It's an incredible story. And it makes you wonder, doesn't it? What other massive, modern problem could be solved by this powerful, time-tested idea?
Okay, so imagine a trader who never sleeps, never panics, and definitely never gets greedy. Sounds like science fiction, right? Well, it's not. It's the reality of systematic trend following. And today, we're going to deconstruct this automated trading machine piece by piece so we can understand exactly how it works.
You know, this quote from our source material really gets to the heart of it. Unlike a human trader who might second-guess a decision or, get caught up in the panic of the moment, this machine is engineered for one thing: to follow trends. Its greatest strength is that it operates without fear, greed, or hesitation, which is just a massive advantage when markets get chaotic.
It might seem super complex from the outside, but as we're about to see, it's actually built on a surprisingly simple set of core components. So let's break them down.
We'll start with a high-level look at the machine itself. Then we'll examine its blueprint, the core building blocks. From there, we'll see how it actually identifies a trend. how it decides how much to bet on it, and finally, we'll uncover where its real advantage, its edge, truly comes from.
All right, first up, let's talk about the machine's overall function. The best way to think of it is as a kind of conversion engine. It's designed to take all that chaotic, raw information from the market, every price tick, every volume surge, and transform it into a single concrete action, a trade. The process is actually beautifully straightforward. On the left, you've got the raw data inputs, price, volume, all that market info. In the middle is the system itself, the black box that we're about to open up. And on the right, the output, a clear, simple decision to take a long or short position. It's a really clean, logical flow from data to action.
Okay, now for the fun part. Let's start taking this machine apart. You might actually be surprised to learn that this whole complex system is built on just a handful of key components and decisions.
Before we get into the nuts and bolts, we need to understand the problems the machine is built to solve. And really, every single action it takes is an answer to one of these four fundamental questions. When do I get in? How much should I bet? When do I get out? And how do I spread my risk around?
And this is how it answers those questions. These 5 building blocks are the functional parts of the machine. It all starts by processing raw data. From that data, it generates a signal to figure out when to enter a trade. It then sizes the position to decide how much to risk, allocates that risk across different markets, and finally, it executes the trade.
So let's zoom in on that second component, signal generation. Think of this as the machine's sensory system. It's how it cuts through all the market noise to see a potential trend forming.
Now, while there are countless ways to generate a signal, most methods really just boil down to 2 core ideas. The first is the moving average. Is the price right now trading above or below its recent average? Simple. The second is the breakout. Has the price just smashed through a recent high or a recent low? Both are just simple ways of figuring out if the market is telling us something new.
Here is a classic moving average signal in action. The blue line is the market price, and the red line is its 20-day average. See that? When the blue line decisively crosses above the red line, the system gets a signal to go long. The exact opposite happens when it crosses below. It's a purely mechanical rule. There's zero room for interpretation.
But finding a trend is only half the battle. The next step, and you could argue it's even more important, is deciding how much capital to risk on that trend. This is where the machine's risk management programming really kicks in.
This whole process is called position sizing, and it's not a guess, it's not a gut feeling, it's a calculated process. The machine uses a specific formula to determine the exact size of the bet, which basically turns risk management into a science. The actual formulas can look pretty intimidating, but they really just boil down to answering 3 key questions. First, how strong is the trend signal we just spotted? Second, what's our overall risk budget for this one trade? And third, how volatile is this particular market? A more volatile market, for example, is going to need a smaller position to keep the overall risk constant. Makes sense, right?
And this is where it gets really interesting. This slide shows a few different ways to link trend strength, that's the horizontal axis, to the position size on the vertical axis. So look at graph C, for example. It's a straight line. The stronger the trend, the bigger the position. Now compare that to graph A, which is basically a simple on or off switch. The system is either all in long or all in short. It can be programmed in any number of ways.
But here's the thing. A trend follower isn't just making one bet. It's making dozens of bets across a whole universe of markets, from commodities to currencies, you name it. So how does it decide how to spread its risk capital across all of those opportunities?
Well, there are 2 main philosophies here, and they have a great real-world analogy. The first is called equal dollar risk, where you basically treat every market the same, kind of like an equal-weighted stock index. The second is market capacity weighting, where you allocate more risk to the bigger, more liquid markets, just like a value-weighted index gives more weight to bigger companies.
This chart drives that point right home. It shows the performance of an equal-weighted S&P 500 versus the traditional value-weighted one. They behave differently because their allocation philosophies are different. The exact same logic applies to how a trend-following system can be designed to spread its risk across dozens of futures markets.
Okay, so we've looked at the building blocks, signal generation, position sizing, and market allocation. Now let's put it all back together and ask the big question. Where does the real advantage of this machine come from? The system's power isn't really in any one single component. There's no magic formula for finding trends. The The real secret sauce is in the integration, the way these simple rules-based parts work together, automatically and relentlessly, 24 hours a day, without ever falling for human emotions like fear or greed. Ultimately, the edge isn't about being smarter than everyone else. It's about being more disciplined. It's systematic, which means every single decision is based on a predefined rule. It's unemotional, and most importantly, it's disciplined. It executes the plan perfectly, every single time. That is the true power of the machine.
And that leaves us with a really fascinating final question. We've just deconstructed the basic machine. If its whole edge comes from its systematic and disciplined application of a set of rules, what happens to that edge when everyone knows what the rules are? Definitely something to think about.
All right, let's get right into it. For decades, we've kind of been taught to see financial markets as this giant machine, complex but predictable, governed by rational laws. But what if that's completely the wrong way to look at it? What if the market is less like physics and a whole lot more like biology? Today, we're diving into a theory that sees the market as a living, breathing ecosystem.
And that brings us to this really fascinating puzzle, one that seems to just break all the old rules. Think about it. In those moments of pure chaos, when markets are crashing and most people are losing their shirts, how is it possible that some people don't just survive but actually consistently thrive? I mean, it sounds totally backwards, right?
And this chart just perfectly captures that mystery. Those blue bars, yeah, those are the bad times. Major global market meltdown since the 1980s. Moments of serious financial pain. But now look at the red bars. They represent a certain kind of investment strategy, and in almost every single crisis, they're going up. How is that even possible? Well, to figure that out, we first need to take a look at the old map of the financial world.
This is the theory that most of us were probably taught at some point, and it's the very reason that chart we just looked at seems, well, like some kind of magic trick.
It's called the efficient markets hypothesis, or EMH. The core idea is pretty simple, really. The market is basically a supercomputer that processes information instantly. By the time you hear a piece of news, it's already priced in. So in this world, trying to beat the market is pointless. You can't outsmart a system that already knows everything you know and more.
But here's the huge problem, and our source material points it out directly. The EMH is static. It treats the market like it's a solved math problem. It has no room for change, for evolution, or for the messy reality of human beings and our emotions. And in that rigid world, strategies that actually seem to work in real life, well, they just don't compute. They shouldn't exist.
So if that old map is wrong, we obviously need a new one. And this is where we throw out the physics textbook and pick up a biology one instead.
So, say hello to the adaptive markets hypothesis, or AMH. This idea from Andrew Lo at MIT says forget the machine. Think of the market as a jungle. It's a massive ecosystem, and it's filled with different species of investors who are all competing for the same thing, profits. And in this jungle, the rules are never fixed. They're always changing. Survival of the fittest isn't just an idea, it's the only law.
And this really lays out the two worldviews perfectly. On one side, you've got EMH. It's all static, rational, predictable, like a physics equation. On the other side, you have AMH. It's dynamic. It's about evolution. It's messy and adaptable, just like biology. This means market efficiency isn't some on or off switch. It actually depends on the environment and who's playing the game. And this is the engine that drives that whole ecosystem. It's a constant cycle. See, when profits are easy to find, when there's plenty of food in the jungle, more competitors show up. That pressure forces everyone to adapt, to evolve, to come up with new strategies. And the ones who can't? Well, they face extinction. This cycle is exactly why a hot strategy from 5 years ago might be completely useless today. The jungle itself has changed. So who are these species running around the financial jungle? Well, they're all the different players. You've got the huge, slow-moving herbivores, like pension funds. You've got these massive schools of fish, that's basically retail investors. And then you have the fast, nimble predators, like hedge funds and other specialized players like CTAs. Each one has its own behaviors, its own rules, and a totally different ability to adapt.
Okay, so if the market's a jungle, then the name of the game is adaptation. But who are the real masters of this art, especially when the environment gets turned upside down, suddenly and violently?
The answer and the solution to our original puzzle comes down to one specific species of investor, the trend followers.
Remember that very first chart? The red bars that went up when everything else went down? Yep, that was them. These strategies are literally built from the ground up to thrive on change.
So how in the world do they do it? It's like a chain reaction. It all starts when stocks fall. Now, most investors are set up to only make money when markets go up, so this creates widespread pain. That pain triggers automatic risk alarms at the big institutions, forcing them to sell whether they want to or not. That forced selling leads to a stampede for the exits, which creates these powerful, persistent trends downward, not just in stocks, but in everything. And a very select few are waiting there, ready to ride that wave.
And this is exactly why trend followers are those adaptable players. First, they operate in markets where it's always easy to buy and sell, so they never get trapped. Second, their strategies are run by computers. There's no fear, no panic. It takes human emotion out of the equation. And crucially, they just don't care if a market is going up or down. And finally, they aren't just in stocks. They trade across all sorts of assets. So wherever a crisis trend appears, they're perfectly positioned to profit from it.
All right, so we've got the theory, adaptive markets, and we have the strategy, trend following. Now let's look at the proof and actually give this unique source of profit its proper name.
It's called crisis alpha. Now in finance, alpha is just the fancy term for skill-based returns. Profits you make because you're smart, not just because the whole market went up. So, crisis alpha is exactly what it sounds like. It's the specific, rare skill of profiting from chaos.
You see, under the old, simple model, returns were just returns. But in this new biological model, we can actually dissect a strategy's performance into 3 distinct pieces. You've got the basic return you get for taking no risk. Then there's the extra bit you might earn in normal times. And then you have this third, incredibly important slice, crisis alpha. It's not just random luck. It's a separate, identifiable source of profit.
And here it is. This is the smoking gun. This data breaks down where the returns of major trend-following strategies actually came from. And for all of them, especially in the last few decades, that blue slice, the crisis alpha, it isn't just a small piece of the pie, it's the dominant driver of their success.
Now let's put that into perspective for a second. These full-blown market crises, they're actually pretty rare. If you look at the data, they only happen about 20 to 25% of the time. The vast majority of the time, markets are just in a normal state. But, and this is the real punchline, that small slice of time is responsible for more than half of the strategy's total profit. It's just an incredible statistic. This demonstrates how powerful this crisis alpha is. It's a specialized survival skill that pays off enormously, but only when the entire ecosystem is under maximum stress. So what's the big takeaway from all this? Why does it matter so much if we shift our thinking from a market as machine to a market as ecosystem?
Well, the number one rule of the ecosystem is that nothing stays the same. What was once a unique, brilliant advantage, a true alpha, eventually gets discovered. Competitors copy it, and over time it just becomes a common strategy, what's known as beta. What this really means is that in an adaptive world, you can't afford to stand still. The only way to survive long-term is to constantly innovate.
And the guy who came up with this theory, Andrew Lo, he said it best. It's necessary to use adaptable approaches because the market environment is always changing. His point is crystal clear. If you're holding on to a rigid, static strategy, you're basically destined to become a fossil.
And that leaves us with one last thing to chew on. This whole adaptive markets idea isn't just some abstract theory for hedge funds. It's a mindset. It forces us all to question our assumptions. So if the market really is a jungle, governed by evolution and adaptation, what old, outdated survival rules might you still be following?
Welcome back to The Explainer, where we tackle the big ideas. Today, we're getting into something really fundamental, 2 completely different ways of looking at financial markets and really at taking any kind of risk. It's a clash of worldviews that quietly shapes every single decision we make. So let me just ask you this one question, because honestly, everything we're about to talk about hinges on how you answer it. Your gut reaction here, whether you realize it or not, pretty much defines your entire approach to risk and reward. It's the hidden architecture behind your choices. All right, let's dive in. To really get our heads around these 2 worldviews, we've got to be super clear about our terms. And that starts with something people mix up all the time, the huge difference between risk and uncertainty. Okay, so risk. The easiest way to think about this is a game of roulette. You know exactly what the odds are, right? You know there are 38 pockets on the wheel. You know the probability of hitting red or black. The outcome? No idea. But the probabilities? Crystal clear. That's risk. But uncertainty, man, that's a whole different beast. This is when you walk up to the table and you don't even know if it's a roulette wheel. You have no clue what the probabilities are. You're flying completely blind. It's a much scarier, much foggier place to be.
So check this out. This is a classic experiment that just nails the difference. You've got two earns. You win 10 grand if you guess the color of the ball we pull out. Earn A, easy. It's a coin flip. 50-50, pure risk. But earn B, who knows? It could be all red, all black, or anywhere in between. That's pure, unadulterated uncertainty.
So, which one are you picking? Which game would you actually pay more money to play? Yeah, if you're like pretty much everyone else, you're picking earn A in a heartbeat. We hate not knowing. We are wired to avoid the ambiguity of earn B. It's called uncertainty aversion, and trust me, it's a massive force in how we all make financial decisions.
Okay, so we've got risk on one side, uncertainty on the other. And this split, this basic difference in how you see the world, gives birth to two totally opposite strategies for getting by. We're talking about convergence versus divergence.
All right, so the convergent thinker is our earn A person. They believe the world has rules, that things will, snap back to normal. They're always betting on things returning to the average. But the divergent thinker, they live in that foggy world of earn B. They start by saying, I don't know, and they believe the world is constantly changing, totally unpredictable.
So how does this actually play out in a betting game? Well, look at these rolls. The convergent guy on the left, he takes his small wins off the table quick. But when he loses, he doubles down, convinced he'll be proven right eventually. The divergent person does the complete opposite. A loser? Cut it. It's gone. A winner? Double down and ride that wave for all it's worth.
Just pause for a second and think about that. If you run these two completely different systems, these two sets of rules for thousands and thousands of bets, what do you think their results are going to look like? And what you get is, well, it's stunning. They are perfect mirror images of each other. The convergent strategy just grinds out these tiny little wins over and over and over. And then bam, one catastrophic loss that just vaporizes everything. And the divergent strategy? It's the opposite. It's just this slow bleed of tiny little losses. And then, out of nowhere, this one massive euphoric win that changes the whole game. Now, to get a little geeky for a second, there's a mathematical way to describe this. That convergent pattern with that huge ugly loss, that's called negative skew. It has a fat left tail. The divergent pattern with that massive win, you guessed it, positive skew, a fat right tail. And this leads to something called a convex payoff, which is just a fancy way of saying your wins can get bigger and bigger, faster and faster. All right, enough with the theory. Let's talk about where you see this stuff in real life, because I promise you it's absolutely everywhere. Think about just crossing the street. That's a classic convergent bet, right? Almost every time you get a small, reliable win. You get to the other side safely. But there's that tiny, tiny chance of a catastrophic loss. Value investing is kind of like that. But on the divergent side, think about a venture capitalist. They're spraying money around, making dozens of little bets, fully expecting most of them to go to zero, just praying for that one home run that pays for everything else. And this is so important. It's not about one being good and one being bad. You actually need both to survive. According to the adaptive markets hypothesis, convergent strategies are great for helping us compete when things are stable. But when things get crazy, when the market goes haywire, it's the divergent strategies that help us adapt, innovate, and, frankly, just survive. So, that leads us to maybe the purest expression of a divergent strategy in all of finance. We're talking about trend following. Yeah, trend followers are the ultimate divergent thinkers. They basically start by saying, I have no idea what anything is actually worth. They don't care why something is moving, just that it's moving. Their whole game is boiled down to those two simple rules. Cut your losers fast and let your winners ride. It's a strategy where you actually go in expecting to be wrong more often than you're right. Wild, huh? And look, this isn't just a theory. Here's the hard data. This chart is showing the skewness, that fat tail we talked about, for a bunch of different investment strategies. And that bar way over on the left, that's pure trend following. It's not even close. It has by far the most positive skew. It is literally engineered to be the most divergent strategy out there. And that's the magic of what we call positive convexity. It just means that your potential upside is way, way bigger than your potential downside. You risk a little to make a whole lot. It's like buying a lottery ticket that actually has a positive expected return over the long haul. That's the holy grail of investing. Man, I love this chart. It's the perfect picture of divergence in action. Every one of those little dots is a trade or a period of time. See that big, ugly blob of dots at the bottom? Those are all the small, annoying losses. That's just the price of doing business. But look up and to the right. As the winds start to kick in, the returns don't just go up in a straight line. They go parabolic. It's those few dots in the top right corner that are responsible for pretty much all the profit. People often call this momentum investing, but this quote really gets at the heart of it. Momentum is just what it looks like on a chart. The real cause, the thing that trend followers are actually betting on, is prolonged market divergence. They get paid when the market just decides to run away from what everyone else thinks is fair value. Okay, so let's wrap this up. What's the bottom line? It all comes back to how you see the world. Is it stable or is it chaotic? Convergent strategies are for harvesting small, steady profits from that stability. Divergent strategies are for hunting those giant, rare payoffs from chaos. And the key is, neither one is right all the time. They're just different tools in the toolbox for different jobs. So I'll leave you with this to think about. If we know that the world is going to serve up both calm seas and crazy storms, if we know for a fact it's both convergent and divergent, what are you going to do about it? How are you going to adapt your own strategy to be ready for both?
Welcome to The Explainer. We're going to tackle a huge question today, one that's on pretty much every investor's mind. Interest rates are finally going up. So is the party over for trend following? Let's dig in. For over 40 years, investors have pretty much only known one environment: falling interest rates. It's been a long, steady ride down. And that world was a fantastic place for a lot of strategies to thrive, especially trend following. But, well, that era is officially over. We are now in a world of rising rates. And that's got a lot of people asking a really critical question. Is trend following in big trouble? All right, let's break this down. To really get to the bottom of it, we have to understand what the actual worry is. What's the logic behind this fear?
So when you look at how interest rates affect trend following, it really boils down to two main things. First, there's the return you earn on your cash. And second, there's the way rates mess with the prices of the futures contracts themselves.
Okay, let's tackle the first part, which is actually the most direct effect. And here's the kicker. It's a clear positive. No two ways about it.
This is what we call collateral yield. See, when you trade futures, you're not fronting all the cash for a position. You just post a smaller amount of cash as collateral. And guess what? In a world with higher interest rates, that cash just sits there earning more and more risk-free interest for you. It's a pretty sweet deal.
And listen, this is not just some small, trivial thing. If you look back to the 1980s when rates were way up, this interest income was a huge piece of the total return. For the last decade or so, with rates near zero, that benefit has basically vanished. Now, it's coming back.
And just look at how powerful this can be. This table shows it all. Let's say you have a strategy with a Sharpe ratio of 0.75. That's your risk-adjusted return. Well, just a 2% yield on your cash can juice that Sharpe ratio by over 20%. That is a massive boost. And there's another awesome benefit to this. That extra cash flow doesn't just bump up your returns. It's also like a cushion. When the strategy is going through a rough patch, a drawdown, that steady income from your collateral can make those periods shorter and a whole lot less painful. Okay, so part one of the puzzle is a clear win for trend following. But now we get to the tricky part. This is where the real investor anxiety comes from. How do interest rates actually affect the price of the futures contracts? See, a futures price doesn't just move because the underlying thing, the spot price, moves. No, the total change in price is actually made up of two pieces. That change in the spot price plus something called the roll yield.
So, what the heck is roll yield, right? Well, futures contracts have expiration dates. So to stay in a trade, you have to sell the one that's about to expire and buy the next one out. The roll yield is just the little profit or loss you make from the price difference between those two contracts. Simple as that.
And believe me, this is so important. It's not just some nerdy academic thing. Just look at this chart. For stuff like bonds and commodities, the roll yield is responsible for a massive part of the historical returns for trend following. We're talking more than half in some cases. It's a huge deal.
All right, so now that we've got the basics down, we can finally tackle the big fear head-on. Let's look at the data. Do rising rates actually hurt the performance we get from these futures? So here's the main worry, especially for bonds. The theory goes like this. In a rising rate world, bond prices are going to trend down. But the roll yield might be positive. So you've got these two forces working against each other, which could basically kill the trend and torpedo your profits. It sounds plausible, right? But is it actually true? Well, when you look at more than 50 years of data for bond futures and you plot rate changes against the roll yield, you find, well, not much of anything really. There's just no clear relationship. The correlation is pretty much zero. Which brings us to a pretty powerful quote. Basically, there's no statistical evidence that supports this idea that roll yield is more likely to hurt trends when rates are rising. The data just doesn't back up the fear. Okay, so the big scare about bonds looks like a bust. But what about commodities? We already saw that roll yield is super important there too. And this is where things get really interesting.
Just look at this chart. The blue line shows the return from roll yield in commodities, and the red line is the Fed funds rate. You don't have to be a statistician to see that they kind of dance together, right? They often move in the same direction.
And it's not just your eyes playing tricks on you. The actual correlation between the two is a positive 0.66. That's a strong relationship. What this tells us is that for commodities, higher interest rates have often meant better performance from roll yield, not worse.
So, let's put it all together. We've looked at the cash collateral and the futures prices. What's the final verdict? Should you be worried about this new world of rising rates?
Okay, so the fear is that rising rates are a big problem. But the reality? It's completely different. First, you get that clear positive boost from the collateral yield that most people forget about. Second, that scary negative impact on bonds, it just doesn't show up in the data. And third, for commodities, it actually looks like higher rates have historically been a good thing. So, let's wrap this up. The big takeaway here is that the fear surrounding rising rates and trend following is, well, it's largely a myth. Not only is the fear overblown, but a higher rate environment can actually be a net positive for the strategy. You get that direct boost from collateral yield, the bond market impact is basically a non-issue, and it might even help in commodities.
And that leaves us with one last thought to chew on. If this widely held truth about interest rates crumbles when you actually look at the data, what other long-held market beliefs, the things we all just assume are true, might be worth a second look?
Welcome to The Explainer, where we break down big ideas. All right, today we're going to talk about an investment strategy that might just flip your whole perspective on market crashes. So let's just jump right in with a pretty provocative question. Could your portfolio actually profit from a market crash? I mean, really think about that. What if all that chaos wasn't something to fear, but was actually an opportunity? So how is that even possible, right? Well, to get our heads around it, we have to look past the usual stuff, stocks and bonds. We've got to dig into this really cool concept called market divergence. Okay, check this out. We all know how traditional assets work, right? Stocks, bonds, it's all about past results and what we expect in the future. But look over at the alternatives. Volatility, that's about how we feel about future risk. And then there's divergence. This is the big one. It's about those huge structural shifts that can totally rock the market. So, what exactly is market divergence? Well, think of it as the fuel for those massive, long-lasting trends. The kind of stuff that happens after a big economic shock. Now, most investment strategies, they get absolutely hammered by that kind of chaos. But trend following, it's built differently. It's designed to be long divergence, which is just a fancy way of saying it's set up to catch and profit from these huge moves. I love this analogy because it makes it so clear. Most strategies, what we call convergent strategies, they're like swimmers in a nice, calm pool. They need things to be stable. But divergent strategies, like trend following, oh, they're the surfers. They're not just putting up with the big waves, they're actively paddling out looking for the gnarliest, most chaotic waves to ride. Okay, so the surfer thing is a great mental picture. But how do we actually, put a number on this? How can we measure a strategy's ability to perform in a crisis? Well, it turns out there's a special tool for that. So first, let's just get on the same page about what we mean by a crisis. If you look at this chart of the S&P 500, you'll see these shaded areas. Those highlight the really nasty periods of market stress. We're talking about the dot-com bust back in the early 2000s, and of course the big one, the 2008 financial crisis. These are the moments that really count. And that brings us to this idea of crisis alpha. It's actually a really simple but brilliant concept. Instead of just looking at performance across the board, crisis alpha zooms in and measures how a strategy did only during those really stressful shaded periods we just saw. It's the ultimate stress test, right? Now, crisis alpha is great for looking back at what happened. It's a report card. But what about trying to look forward? For that, we need to talk about beta. And no, probably not the beta you're used to hearing about. See, the problem with standard beta is that it just averages everything together, which can be super misleading. A trend-following strategy might actually go up with the market and then go up even more when the market crashes. So the positive and negative correlations can kind of cancel each other out, making the beta look like it's zero, like there's no relationship at all. Crisis beta is way smarter. It measures the relationship conditionally. It only asks one question. What does this thing do when the market is tanking? And boom, this chart says it all. This is the money shot. Just look at that blue line. That's the standard beta. It is all over the place. It's totally noisy and unpredictable. But now, look at the red line. That's crisis beta. See how stable that is and how it's consistently negative? That tells you there's a real dependable relationship here. When markets are in crisis, this kind of strategy tends to do well. So here's the key takeaway. When you average all this out across a bunch of different trend-following funds, the picture becomes crystal clear. The average standard beta, it's basically just noise, right around zero. But the average crisis beta, it's deeply, consistently negative. That is the kind of diversification that can actually help you when things go wrong. Okay, but here's a really, really important catch, and you got to pay attention to this part. Not all strategies that slap the trend-following label on themselves are created equal. The specific way a strategy is designed, the choices the manager makes, can either protect this incredible crisis-fighting ability, or honestly, it can totally wreck it. All right, to see exactly what I'm talking about, let's look at two different approaches. We've got System 1 here. Think of this as the pure version. It has no built-in bias to be long stocks, and it spreads its risk equally across a ton of different markets. Then you've got System 8. This one is different. It's kind of designed to look a little more like a traditional portfolio. It has a bias to be long equities, and it focuses just on the biggest markets. And wow, the difference in performance is just stunning. When a crisis hits, that pure System 1 delivers exactly what you want. Strong, positive returns. That's crisis alpha right there. But the bias system, it pretty much breaks even. It completely loses its superpower, the most valuable thing about it. Okay, next up is something called skewness. And the easiest way to think about it is like this. Positive skew, which is what the pure system has, is like buying a lottery ticket. You have a bunch of small, affordable losses, the cost of the tickets, but you also have the chance for a massive, life-changing win. The bias system, it flips to negative skew. That's more like selling insurance. You collect a bunch of small payments, which feels great, but you're always living with the risk of one giant, catastrophic payout that could wipe you out. And finally, maybe the most important chart of all, its correlation to stocks. The pure system 1, it does exactly what she wanted to do. It has a negative correlation, which means it's a true diversifier. But look at the biased system 8. Because it was designed with that tilt towards stocks, it actually becomes positively correlated. It moves with the stock market, which completely defeats the whole point of adding it to your portfolio in the first place. So the takeaway here, and this comes straight from the source material, is just crystal clear. The trend-following systems that are the most divergent, the ones that don't try to sneak in traditional biases like being long stocks, those are the ones that actually deliver that high crisis performance, that positive skewness, and that low correlation we've been talking about. Which kind of leaves us with one big final question to think about for your own portfolio. Maybe true diversification isn't just about owning a bunch of different stocks and bonds. Maybe it's about owning a totally different philosophy, one that isn't built to just weather the storm, but one that's built to actually ride the wave. So you have to ask yourself, is your portfolio built to be convergent, or is it built to be divergent?
All right, I've got a pretty wild idea for you today, one that kind of flips everything we think we know about investing on its head. What if I told you that the real secret to winning is actually losing? Most of the time anyway.
No, really, just let that sink in for a second. What if the path to making money in the long run wasn't this perfect, steady climb to the top? What if it meant you were actually down from your peak almost all the time? It sounds completely backward, I know, but the data tells a really fascinating story.
Check out this number, 94%. So there was a study on a super successful long-term strategy called trend following. You know, the kind that's designed to catch those big market waves. Well, it found that the system was technically in a state of loss, meaning below its all-time high, a whopping 94% of the time.
And this is what that looks like. See all that blue area below the zero line? Every single bit of it represents a time of loss. For almost 50 years, this very profitable system spent nearly its entire life underwater, sitting below its last peak. And that right there is exactly what we call a drawdown.
Okay, so before we go any further, let's get crystal clear on what we're talking about. What exactly is a drawdown?
So it's not just any old loss. A drawdown is very specific. It measures the drop from an investment's absolute highest point down to its next lowest point. It's basically the answer to the question, how far have I fallen from my best day ever?
You know, the easiest way to picture it is to think about climbing a mountain. Every time you hit a new, higher summit, that's your new peak value. But you almost never just go straight up, right? Anytime you have to dip down into a valley before you can start climbing again, well, you're in a drawdown. You're simply below the highest point you've reached so far.
Okay, so if these drawdowns are just a normal part of the journey, the next obvious question any sane investor is going to ask is, just how bad can it get? You know, how deep does that valley go?
And that brings us to this key idea called maximum drawdown. You can think of this as the ultimate stress test. It measures the single biggest drop from a peak to a trough over a long period. It's the absolute worst-case scenario that, let's be honest, we all tend to fixate on.
But are these huge dips really that unusual? Well, take a look at this. The average dip within a year for that special trend-following system was about 17%. And for the good old S&P 500, it was actually more, at over 18%. So what's the big takeaway here? It's that these big drops aren't some weird exception. They are a totally normal, expected part of investing, even for the market as a whole.
All right, so we've established that drawdowns are normal, and we have an idea of how deep they can get. The next million-dollar question is, of course, how long do they last? How long are we stuck wandering in that valley before we start climbing toward a new peak?
This chart is just so cool. On the bottom, you have the time it takes to fall into the drawdown. And on the side, you have the time it takes to get back to even. Now look where all those little blue dots are clustered. See how most of them are above that diagonal line? They're all sitting in the faster recovery period zone. The research puts it perfectly. Basically, what all that data is telling us is that the climb out of the hole is usually way faster than the slide into it. The recovery period tends to be about twice as fast as the loss period. That's a pretty big deal.
So, we've covered the what, the how deep, and the how long. But now we get to what I think is the most important question of all, the one that really pulls back the curtain on how this whole strategy works. What is actually causing these things to happen in the first place?
So what do you think? What's the real culprit behind a major drawdown? Is it a few massive, catastrophic bets that just go horribly wrong and blow a hole in the portfolio? Or is it something else? Is it more like a death by 1,000 cuts? A slow accumulation of many, many small, managed losses?
And the answer is the 1,000 cuts. It's the accumulation of many small losses. This chart lays it all out, plain as day. Look at the bottom axis. As the percentage of winning markets gets lower and lower, just watch what happens to the portfolio return on the side axis. It tanks. This proves that drawdowns aren't caused by a few giant mistakes. They're caused by having lots and lots of small, disciplined losses while you wait for the few big trends that make all the money.
So let's just tie this all together. In a system like this, drawdowns are not a sign that something is broken. They're actually a sign that everything is working exactly as it should be. They're the predictable, unavoidable costs of doing business. It's the price you pay for staying in the game, taking those small managed cuts, so you can be there to catch the few big winners that drive all the returns. It is absolutely 100% a feature, not a bug.
And that really just leaves us with this final thought. Once you understand this, it totally flips the script on how you should think about risk. The goal isn't to try and avoid losses. I mean, come on, that's impossible. The real goal is to have a strategy where losses are an expected, managed part of a system that's designed for huge long-term wins. So the question you really need to ask yourself isn't if you'll face a loss. It's does your strategy know how to win because of the way it loses?
Welcome to The Explainer. Today, we're going to dig into something really fascinating, investment risk. We're going to ask a really important question. Are those performance metrics you rely on actually telling you the whole truth? Or is there something lurking just beneath the surface that could really, really cost you? Okay, so let's just jump right into it. We're all taught this, right? A high Sharpen ratio, that's the holy grail of investing. It means you found a great investment. But what if that single number, that one metric we all chase, is actually a mask? What if it's hiding risks that aren't just bad, but catastrophic? So yeah, the Sharpe ratio is king. It's probably the most popular metric on the planet. And its job seems simple, right? It measures the return you're getting for the amount of risk you're taking on. But here's the catch, and it's a big one. It's all built on this one huge assumption, that risk just means price volatility. You know, how much the price bounces around. And believe me, that's exactly where the story starts to get really interesting. Okay, but think about it. What about all the other kinds of risks? The ones that aren't just about those day-to-day wiggles on a chart? Well, the source material we're looking at has a great name for them: hidden risks. And they're kind of like a ticking time bomb. They can just sit there totally dormant for years. Your standard metrics won't see them at all. And then, bam, a market crisis hits and they blow up. So to really get our heads around this, we need a better way to look at it, a new framework. Let's break down what the source identifies as the 4 main types of investment risk. It's the only way to see what's out in the open and what's hiding in the shadows. And here they are. You can think of them as the 4 horsemen of investment risk. First, you've got price risk. That's the obvious one, just unfavorable market moves. Then, leverage risk, the risk you take on when you use borrowed money. Third is credit risk, which is basically the chance that your counterparty, the other person in the deal, just plain defaults. And finally, liquidity risk. That's the scary one, where you can't sell an asset quickly without taking a massive hit on the price. Now, this is where it gets really clear. We can actually map these risks out on a spectrum. Over on the left, you've got what we'll call the unhidden risks, things like price and leverage. They're pretty transparent, you can usually see them. But as we move over to the right side of this chart, we get into the really dangerous territory, the hidden risks of credit and liquidity. And these are the ones that are so much harder to see coming. And this right here, this is the crucial point. Different investment strategies play in different parts of the sandbox. Trend-following strategies, well, they primarily live over on the left side, dealing with those transparent, unhidden risks. But a lot of other strategies, what the paper calls convergent strategies, you know, the ones that bet on prices going back to normal, they tend to hang out on the right, taking on all that hidden credit and liquidity risk. Okay, so that's the theory, but how can we actually prove this? How do we see it play out in the real world? Well, there's a really cool measure called crisis alpha. It's pretty simple. It just shows you which strategies tend to make money during a market meltdown and which ones get absolutely crushed. You can think of it as the ultimate stress test for these hidden risks. All right, first up, price risk. Just look at this chart. The strategies with positive crisis alpha are on the left, and what do you see? A whole cluster of CTAs. Those are the trend followers. They're squarely in the positive zone, meaning they tend to navigate price risk really well during a crisis. Okay, now watch what happens when we switch to credit risk. It's like the whole thing flips. The trend followers are now way over on the right, showing they have very little exposure to this hidden risk. Meanwhile, the strategies on the left, they're the ones getting hammered with deeply negative crisis alpha. They're the ones blowing up from credit problems. And you guessed it, we see the exact same story when we look at liquidity risk. Again, the trend followers are clustered on the right. They're not carrying these hidden liquidity risks that cause other strategies to completely fall apart when the markets freeze up and you can't sell anything. They just don't have that blow-up potential. So, this brings us right back to that myth we started with. If these other strategies are loaded with all this hidden danger, how in the world do they have such fantastic-looking Sharpe ratios? Well, the answer is a little bit of financial engineering, a trick called dynamic leveraging. Okay, this chart right here is the big reveal. It tells the whole story. Look at the red bars. Those represent typical hedge fund strategies. See how high the Sharpe ratio is on a short-term monthly basis? It looks amazing. But then, as you look over longer and longer time horizons, it shrinks. Why? Because those hidden risks start to surface. Now, look at the blue bars for trend following. It's the opposite story. The Sharpe is more stable, more consistent, and it actually gets better over time. So where does that short-term magic trick come from? It's that dynamic leveraging we mentioned. The best way to think about it is like doubling down at the blackjack table. Every time you lose a hand, you double your bet, hoping to win it all back in one go. And it works. It creates this beautiful, smooth-looking stream of returns, right up until the moment you have a string of bad luck and you lose everything. It's the illusion of safety, but it's hiding a catastrophic risk.
Okay, so what's the actual price you pay for chasing that perfect, smooth return stream? Let's put some numbers on it. Let's take a basic trend-following strategy and then bolt on one of these dynamic leverage strategies, like selling options, for example, and just see what happens to the risk profile. First off, your potential losses just explode. The maximum drawdown, that's the biggest drop from a peak to a trough you can experience, it jumps from 26% all the way up to a gut-wrenching 45%. Suddenly, that hidden risk doesn't seem so hidden anymore, does it? Second, the entire character of your returns gets warped. What we call the skewness flips to negative. And what that means in plain English is you've built a strategy that makes a lot of tiny little gains, but is set up for rare but absolutely massive losses. It's the classic definition of picking up pennies in front of a steamroller. And maybe worst of all, your protection during a crisis, it's gone. It's completely wiped out. That positive crisis alpha we saw earlier, that beautiful insurance policy that was paying you over 5% during a downturn, it doesn't just go to zero. It actually turns negative. You've traded your insurance for a lottery ticket that's likely to blow up. So what this all really builds up to is a totally new way to think about risk. It's about looking past that one shiny number, the Sharpe ratio, and really, truly understanding the source of your returns. So here's the bottom line. A high Sharpe ratio on its own is not the whole story, not even close. You have to ask yourself, what kind of risk is generating that return? Is it transparent, unhidden price risk, or is it sneaky, hidden credit and liquidity risk that's just been smoothed over to look pretty? In fact, what this suggests is that a more stable, even a slightly lower Sharpe ratio might actually be the sign of a much more prudent and ultimately better strategy. And this quote from the paper we're looking at just hits the nail on the head. It says that higher returns for trend following are much more likely to come from just riding a price trend, not from using concentrated hidden risks or that dynamic leveraging trick. So we'll leave you with this final thought. The next time you're shown a strategy with one of those picture-perfect, incredibly smooth, high Sharpe ratio return streams, you'll know what to do. You'll know to stop and ask the most important question of all. Is this genuine skill I'm looking at, or is it just hidden risk in a very pretty package? What if I told you there's an investment strategy that has not just survived, but actually thrived through centuries of wars, depressions, and massive technological revolutions? Well, today, we're going to take that very strategy and put it through the ultimate stress test against the wild forces of our modern economy. Okay, so take a look at this. What you're seeing is the incredible 300-year performance of an investment strategy. It's plotted on a log scale because otherwise you couldn't even fit its massive growth on the screen. This thing has endured for centuries. So the big question is, can it hold up in the world we live in today? So what is this magic strategy? It's called trend following. And the core idea is, well, it's brilliantly simple. You just try to capture profits by riding major market trends. It doesn't care if a market is soaring or if it's crashing. As long as there's a strong, sustained move in one direction, it aims to be along for that ride. All right, so before we start throwing some modern-day curveballs at it, let's first get a real sense of just how tough this champion has been over the very, very long haul. Now, one of the key ways we measure any strategy is its Sharpe ratio. That's just a fancy way of saying, how much return are you getting for the risk you're taking? Well, over 3 centuries, this strategy delivered a Sharpe ratio of 0.72. And let me tell you, that is impressive. It shows us this hasn't just been about getting lucky with big returns. It's about smart, risk-adjusted performance year after year. And this right here is its superpower. This chart is so important. Look at the blue bars. Those are months when the stock market is losing money. Painful times, right? Now, look at the red bars. That's trend following. On average, it's actually making money in those same months. It zigs when the market zags, and that acts as an incredible buffer when you need it most. So that's the history. Pretty amazing. But can this old school strategy really survive one of the biggest forces in all of modern finance? Huge, massive swings in interest rates? Let's find out. When you look at U.S. interest rates over the last 60 years or so, you're basically looking at 2 completely different worlds. First, you had this long, brutal grind of rising rates that peaked way up in the early 80s. And then, for decades after, rates just fell and fell. These are polar opposite environments, the perfect test case. So how did trend following do? You might be surprised. It did remarkably well. I mean, look at this chart. The performance was strong and consistent across both of those completely different worlds. It delivered a sharp ratio of about 0.95 when rates were rising and a still really solid 0.65 when rates were falling. So the big takeaway here? The actual direction of interest rates doesn't really seem to matter all that much. As long as there's a sustained trend, doesn't matter if it's up or down, that creates momentum, the strategy can work. So test 1, passed with flying colors. Okay, on to our next stress test. This is a big one. What happens when governments and central banks decide to stop letting markets be free and, start meddling? Well, it turns out that for a trend follower, not all intervention is created equal. Some of it is like hitting a brick wall. It creates these sudden, sharp shocks that just kill a trend dead in its tracks. But other times, it's like having a powerful tailwind at your back, creating the exact kind of long, steady, policy-driven trends that this strategy absolutely loves. Here's a perfect example of bad intervention. In early 2014, the Turkish lira was in a very clear downward trend. Then, bam, overnight, the central bank jacked up interest rates. You can see what happened. A violent, sudden reversal that would have caught any trend-following system completely by surprise. But on the flip side, just look at Japan's lost decade back in the 90s. This was a time of constant government and central bank action, and all that intervention created these incredibly powerful, long-lasting trends. Trend following on Japanese government bonds, for example, had a phenomenal Sharpe ratio of almost 1.0. That's just fantastic. So the verdict here is, well, it's a bit more nuanced. Government meddling is clearly a double-edged sword. It has the power to create some amazingly profitable long-term trends, but it can also destroy them in an instant. All right, for our final test, let's pit this strategy against one of the most powerful and relentless bull markets in modern history, that slow, steady recovery after the 2008 financial crisis. I mean, from the bottom in 2009, the S&P 500 just went on an absolute tear. It created this slow, steady, enormous uptrend, gaining 175% in 5 years. On paper, this seems like an absolute dream come true for a trend-following strategy. So the obvious question is, did the strategy capture this massive, massive win? You'd think it crushed it, right? Well, the answer is actually a lot more complex than you might think. It all came down to the speed of the system, basically how quickly it reacts to price changes. The slower systems, the ones that look at very long-term price movements, they did pretty well capturing this big, lazy trend. But here's the kicker. The faster and medium-term systems, the ones that actually have the best long-term track records, they kind of struggled. That slow, steady grind of the rally wasn't the kind of energetic trend they're built to capture. So after putting this 300-year-old champion through the modern gauntlet, interest rate shocks, government meddling, unique market rallies, what have we actually learned? What's the final verdict? At the end of the day, trend following is not a magic crystal ball. It doesn't predict the future. Its real genius lies in its disciplined ability to adapt to powerful trends after they've already started, no matter what caused them. It's tough enough to handle big economic shifts like interest rates, but its performance really depends on the character of the trend itself. Is it a smooth ride or a sudden shock? That's what matters. And this leaves us with one last big thought. In a world that seems to get more chaotic and unpredictable every single year, with constant interventions and crises coming out of nowhere, maybe a strategy that is built purely on adaptation is the most rational approach of all. Something to think about.
All right, let's dive right into the world of trend following. It's one of the most popular strategies out there for sure. But today, we're going to poke a hole in a really common and kind of dangerous assumption. The idea that all trend followers are pretty much doing the same thing. As you're about to see, the truth is way, way more complicated.
It's so easy to look at a bunch of trend-following funds and think, hey, they're all playing the same game, especially when their returns seem to move together. But trust me, that assumption can be a really costly mistake. Let's kick things off with a little visual puzzle that just perfectly sets the stage for what we're talking about.
Okay, so take a good look at this.
On top, you've got asset 1 and asset 2. They look like twins, right? Almost identical. And then on the bottom, asset 1 and asset 3 look like total opposites. Well, get ready for a twist, because mathematically, the reality is the exact opposite of what your eyes are telling you. Asset 1 is actually perfectly negatively correlated with asset 2 and perfectly positively correlated with asset 3. It's just a wild example of how our intuition can totally mislead us in the world of investing.
And that right there, that illusion of sameness, is a massive trap, especially when it comes to trend-following strategies. They might all look the same from a distance, but when you get under the hood, they can be completely different animals. This leads us to a really crucial concept that helps explain why.
It's this idea called return dispersion. Basically, it's the shocking difference you can see between the best and worst performers, even when they're all supposedly running the same basic strategy. So what on earth is causing this huge gap in their results? Well, let's break it down.
To really get a handle on return dispersion, we need to pop the hood and look at the actual blueprint of a trend-following system. It turns out that just a few small choices in the design phase can lead to gigantic differences in the end.
Think about it like this. A manager's entire strategy can be built on just a handful of key decisions. Do they lean towards buying stocks? Yes or no? Do they decide how much to invest based on market size, or do they aim for equal risk in every position? Do they hold trades for the medium term, or are they in it for the long haul? Just these 3 simple choices create 8 fundamentally different systems.
And here is the proof in the pudding. Check out 2012. System 8 was the absolute champion, no contest. But then you rewind to 2009, and it's a completely different story. System 2 was the one that came out on top. It just goes to show you what works like magic one year might totally flop the next, and vice versa.
Okay, let's peel back another layer. So beyond that basic blueprint, managers have this sort of control panel with all these little dials they can turn to tweak and fine-tune their strategy. And believe me, these tiny adjustments can have an absolutely massive impact.
We're going to focus on 2 of these dials. The first one is what's called the look-back window. It sounds technical, but it's really simple. It's just how much past data this system uses to make a decision. Are we looking at the last 30 days? The last 200? It might seem like a tiny detail, but as you're about to see, it is anything but.
This slide just says it all, doesn't it? Every single dot here is a different look-back setting. Now look at 2008. The gap between the best performer and the worst was over 30%. That is a staggering difference, and it all came down to one little tweak on a single dial.
And the second dial? Sector allocation. In 2013, if you decided to overweight equities, you had a great year. But if you bet on fixed income instead, ouch, a huge loss. We're talking about the same year, the same type of strategy, but just wildly different outcomes.
So after seeing all that, you might be thinking, aha, I get it. The trick is just to pick the right settings for the coming year. But, well, the data tells a very different and actually a much more humbling story.
This quote from the original research is a real mind-bender. What the researchers found was that if you consistently picked last year's best performing settings, you did no better than if you had picked last year's worst performing settings. In the long run, it was basically a wash.
So what's the big takeaway here? It's that what works one year is essentially random noise. Trying to predict which settings will be perfect for the future is a total losing game. It's like trying to guess the winning lottery numbers based on last week's drawing.
Okay, so if timing the market by picking the right parameters is a myth, what's the real lesson here for us as investors? Well, as it so often is in finance, the answer is all about taking the long view.
The data is pretty clear on this. All of that short-term chaos, all that randomness from different settings and system designs, it eventually just fades away. Once you stretch your time horizon out long enough, all that noise cancels out, and the real underlying performance of the strategy starts to shine through.
And that leaves us with this final, and I think most important idea to chew on. Maybe the key to success in trend following isn't about having the perfect system or finding the magic settings. Maybe it's just about having the patience and the discipline to pick a good one and then stick with it through all the ups and downs.
All right, let's jump right in. If you're at all into systematic investing, you've definitely heard of trend following. The idea sounds so simple, right? Just ride your winners and cut your losers. But when you actually look at the performance of different trend-following funds, that simplicity just vanishes. It's a mess. So how in the world are you supposed to find your bearings? I mean, just look at this.
every single one of these lines is a major trend-following fund. They're all supposed to be playing the same game, they're even normalized for the same amount of risk, but the results? They are all over the map. One zigs, the other zags. If you're an investor trying to pick the right one, good luck. It's a massive challenge just to figure out what's going on. And that's the big question we're tackling here. In a space that looks this chaotic, how do we find a true north? Is there a reliable compass, some kind of pure benchmark we can use to navigate all of this and actually make sense of these wild results? Well, turns out there is. But to find it, we have to start with a philosophy. To get to the bottom of all that chaos, we need to look past the performance charts and get to the philosophy underneath it all. And it turns out there's a surprisingly simple and unifying idea at the heart of it called divergent risk-taking. It's really the bedrock of all trend following. So what exactly is it? Well, divergent risk-taking is a philosophy built on one really profound, and you could even say humble, assumption. You don't know what the future holds. You just don't. And because you assume ignorance, you don't try to be a hero and predict anything. Instead, you just systematically cut your losses when a trade goes south. But, and this is key, you let your winners run as far as they possibly can. You're hunting for those big, unexpected moves. Now, this approach is basically the polar opposite of how most of us are taught to think about investing. Over on the right, you've got convergent thinking. That's your classic buy low, sell high. It's all about predicting that a stock is cheap and will eventually bounce back to its true price. But over on the left, you have divergent thinking. It couldn't care less about value. It only cares about momentum and risk management. And that leads to a totally different kind of portfolio, one that's defined by lots of small, manageable losses and a few enormous, game-changing wins. And this right here, this is probably the most critical takeaway about this whole philosophy. For a divergent, trend-following strategy, when you get in is way less important than when you get out. The entire game is won or lost on the exit. It's all about disciplined risk management, not some secret, magical entry signal. And wow, does this chart drive that point home? This is the infamous tulip mania bubble from way back in the 1630s. Look, anyone who bought tulips in November was a genius by January. But the real genius? That was the person who had a disciplined exit strategy. The trader who cut their position at the very first sign of trouble in February walked away with a small loss. The person who held on, praying for a rebound, well, they lost everything by May. The exit is everything. Okay, so if the exit is the key to everything, how do we use that to build our compass? I mean, we can't just average together all those messy funds from that first chart. That's just naive and wouldn't tell us anything. No, instead, we have to build a pure strategy from the ground up, based only on these core principles of divergent risk-taking. And so this is it. This is our true north, the Divergent Trend Following Index, or DI for short. You can think of this as a theoretical benchmark, a pure distillation of the strategy, built on just 5 simple, totally agnostic rules that capture the absolute essence of that divergent philosophy. It's not trying to be clever or complicated, it's trying to be pure. Let's just quickly walk through these rules, because their simplicity is what makes this whole thing so powerful. First up, risk allocation. It puts the same amount of risk on the table for every single market, from corn to crude oil to currencies, no favorites. Second, loss tolerance. It assumes the same pain threshold for a loss, no matter the market. Third, and this is the real engine room, the exit strategy. It uses a dead simple trailing stop. If a price drops by a set amount, you are out. No motion, no second guessing, you're just gone. Fourth, the entry. You only start looking for a new trade after you've been stopped out of an old one. And finally, selectivity. The model has zero bias. It doesn't prefer stocks over bonds or commodities over currencies. It is completely mechanically neutral. So we've built this simple, elegant, theoretical model. It's our compass. But, a compass is pretty useless if it doesn't actually point north. So does this theoretical index, does it actually reflect what's happening in the real, messy, complex world of professional trend following? This is the moment of truth. We took a philosophy, we boiled it down to 5 simple rules, and we created this index. Now we're going to put it to the test. Let's see how our pure DI stacks up against the real-world indices run by actual managers. And there it is. This is the big aha moment. Just take a look. That green line in both of these charts, that's our super simple 5-rule divergent index. On the left, it's plotted against indices of actual human-run funds. On the right, against other computer-driven trend indices. The resemblance is, well, it's stunning. Our simple theoretical model tracks the messy, complex real world with incredible accuracy. The compass works. So how close is it really? The correlation between our simple DI and most major manager-based indices is about 80%, and that is huge. What this proves is that the core engine driving this entire multi-billion-dollar industry is, at its heart, just this disciplined, divergent approach to risk. Everything else is kind of just noise around the edges. So, okay, the compass works. Fantastic. Now that we have this true north, we can do something really powerful with it. We can actually use it to understand that initial chaos we saw at the beginning, to analyze how and, more importantly, why individual managers deviate from this pure benchmark.
So think of the DI as the baseline, the market return for trend following. Any deviation from that line isn't random noise. It's an intentional choice made by a manager. And these choices, these deviations, are called style factors. They're basically a way to measure the specific biases or tilts a manager is adding on top of the pure strategy.
And here's a perfect example to make it concrete. Remember, our pure DI has absolutely no preference for any asset, but a manager might decide to add an equity bias. That just means they're more likely to take long positions in stocks. Now, that can definitely boost your returns when the stock market is flying high, but there's always a trade-off, right? The catch is it dilutes one of the key benefits of trend following, its ability to protect you during a stock market crash. It's a specific choice with very specific consequences.
And this brings us right back to where we started. It shows that despite all the complexity, all the marketing, all the secret sauce that fund managers talk about, trend following at its core is really about one simple, powerful idea: being incredibly diligent with how you allocate risk and being absolutely ruthless in your discipline to cut your losses.
And that leaves us with one final pretty big thought to chew on. We just saw how a purely mechanical strategy, one that is based entirely on discipline and a frank admission that we can't see the future, can successfully define and track an entire segment of the investment world. If that's true, what does that say about our wider obsession with prediction and forecasting in the rest of the investing world? It's something to think about.
You know how it is. Fund managers love to throw around these really impressive-sounding words, right? Opportunistic, global macro, value-driven. It all sounds great, but what they're actually doing often feels like a total black box. So how do you cut through all that marketing talk and see what's really going on with your money?
I mean, that's the big question for any of us who invest, isn't it? You hand over your hard-earned capital, and you have to trust that they're sticking to the plan you both agreed on. But are they really?
Well, here's the cool part. You don't need to hack into their computers or get a hold of some secret trading algorithm. The answer? It's been hiding in plain sight the whole time, right there in their performance data. All you need are their monthly returns. Seriously, that's it. If you know how to look at them, you can completely crack the code.
Okay, so let's get into it. For way too long, investors have just had to go on a manager's word and, frankly, a little bit of faith. But when your money's on the line, that's just not good enough. We've got to find a way to peek inside that black box.
Managers will give you all sorts of descriptions, but as the source material for this explainer points out, that stuff is difficult to quantify or classify systematically. Words are fuzzy. We need something that cuts through the noise, a tool that can translate their actual actions, their trades, into a clear number-driven picture.
And believe it or not, that tool actually exists. The best way to think about it is like a financial DNA test, but for an investment fund. It's a way to break down a manager's performance and see the actual fundamental building blocks of their strategy.
So the official name for this is return-based style analysis. It's actually been around for a while. It was first dreamed up by William Sharpe way back in 1992. And the idea is just brilliant because it's so simple. All you do is compare a fund's returns to the returns of different market factors. And suddenly, you can see exactly what's driving their performance. It's like we're reverse engineering their whole strategy.
So if we're doing this DNA test, what are the genes we're looking for, especially when it comes to trend-following funds? Well, this analysis points to 4 key things. First up is trend exposure. You might hear it called beta. This basically just tells us how much they act like a textbook trend follower. Next is size. Are they playing in the big, well-known markets, or are they hunting in the smaller ones? Third, we've got equity bias. Are they kind of secretly betting on stocks to keep going up? And last but not least, speed. Is their system designed for quick in-and-out trades, or is it built for those slow, long-term trends?
Okay, this is where it gets really good. Because when you actually take this financial DNA test and apply it to real-world managers, well, the results are pretty mind-blowing. All right, first things first. We need to establish a baseline, right? We need to know what normal looks like. So this chart here shows the trend exposure for a couple of major industry indices. You can think of this as the average manager profile. Yeah, there are some little differences, but for the most part, they're all kind of clustered together. This is our starting point.
But check out what happens when we run the exact same test on individual managers, who are all supposed to be in the same bucket. The picture just completely falls apart. Look at this. The variation is huge. Some are way up here with super high trend exposure. Others are way down there. It is a world away from those neat, tidy averages we just looked at.
And this really gets to the heart of it. And there's a quote from the source material that just nails it. It says they all have their own loadings on these style factors. Loadings is just a fancy way of saying they each have their own unique recipe, their own unique exposure. So just because two managers both call themselves a trend follower, it doesn't mean they're doing anything remotely similar, not even close.
Let's make this real. Let's look at a tale of two traders pulled right from the data. On one side, you have CTA4. Let's call them the big leaguer. Their DNA shows a strong negative size beta, which tells us they stick to the big, well-known markets. But then you have CTA1, the scout. They've got a positive size beta, meaning they're out there looking for chances in smaller, maybe less obvious markets. The crazy thing is, both are successful trend followers, but their financial DNA shows they're playing two completely different games.
Okay, and this is where the analysis stops being just interesting and turns into a full-on investigative tool. It's like we're financial detectives, and we can use this to find stuff that managers, well, let's just say they're not putting it on the front page of their reports. Okay, check this out. The analysis was run on 3 different managers who all say, we are non-trend followers. Now, for 2 of them, NCTA1 and NCTA3, the R-squared value is basically 0. And that R-squared number just tells us how well a trend-following model explains what they're doing. So a low number means, yep, the model doesn't fit. That's exactly what you want to see for a non-trend manager. But then there's NCTA2. Their R-squared comes in at 0.46. Let that sink in. That means almost half, 46%, of their performance can be explained by a basic trend-following model. This is a manager who says they are not a trend follower, but the returns are singing a very, very different tune.
Right there, that's the smoking gun. The numbers have just revealed this huge gap between what the manager says they are and what their strategy actually is. And think about it, without this kind of analysis, you, the investor, would be completely in the dark.
And it's not just about finding imposters. The tool is also amazing at catching something called style drift. So take a look at this chart for manager CTA5. You're seeing their exposure to different factors over time. Now zero in on what happens around 2011. See that? Their trend exposure, that's the red line, it just takes a nosedive. And right at the same time, their equity bias, the purple line, starts creeping up. This manager completely changed their strategy mid-game, and this analysis caught him red-handed.
So, let's bring this all together. What does this actually mean for you, the investor? Simply put, it means you don't have to fly blind anymore. It's like you've been given a pair of X-ray glasses for your portfolio.
And the applications here are huge. You can finally make real apples-to-apples comparisons between managers. You can pick managers whose financial DNA actually lines up with what you're trying to achieve. You can finally understand why a manager is doing well or poorly. And like we just saw, you can make damn sure the manager you hired is actually sticking to the script.
Now there is one last little wrinkle to all this. The baseline you compare against, it really matters. It's like choosing a different lens for your camera. You could compare a manager to a pure textbook trend-following approach, or you could compare them to what the biggest funds in the game are doing. Neither one is necessarily right or wrong. They just give you a different angle, a different perspective on the same manager's strategy.
At the end of the day, this is about so much more than just some clever math. This is about pulling back the curtain on an industry that can be, let's be honest, incredibly opaque. What we have here is a tool for real transparency. It's a way to hold people accountable, and ultimately, it's a way for all of us to make smarter, more informed decisions with our money.
And that really leaves us with a final, bigger thought. This whole idea of using the outputs of a system to understand what's really happening inside, it's incredibly powerful. I mean, if we can do this for fund management, just imagine what other black box industries out there could use a dose of this X-ray vision. What other secrets are just sitting there in the data waiting for us to find them?
All right, welcome back. Today we're diving into a really cool investing puzzle. It's one of those counterintuitive stories about how a seemingly smart, data-driven decision to improve an investment strategy can actually make your whole portfolio a lot weaker. It's that classic case of winning the battle but losing the war. So let me just ask you this. When the markets are in a free fall and everyone's portfolio is bleeding red ink, is it even possible to profit from all that chaos? Well, the answer is a big yes. And the way to do it has a pretty awesome name.
It's called Crisis Alpha, and you can think of it as your portfolio's own personal superhero. When everything else was crashing and burning, a strategy with Crisis Alpha is designed to soar. And we're not just talking about losing less money, we're talking about generating actual positive returns that help cancel out the damage happening everywhere else. It really is the ultimate portfolio firefighter.
So the big question is, how do you get this superpower? Well, one of the most well-known strategies for generating crisis alpha is something called trend following.
Now, the concept behind trend following is actually beautiful in its simplicity. Trend followers don't try to predict the future. They're not staring into a crystal ball. They just identify trends that are already happening across a ton of different markets. We're talking bonds, currencies, commodities, and stocks too. And they just ride the wave. If something is in a solid uptrend, they buy it. If it's in a serious downtrend, they short it. It's systematic, it's disciplined, and it's famous for showing up and doing its job when you need it most, during a crisis.
But here's where our story takes a really interesting turn. Because for all its strengths, when you pop the hood on a typical trend-following strategy, you find this surprising little weakness, a real crack in the armor. And it's hiding in the one place you might not expect, the stock market. Okay, let's look at the data. This chart here shows the performance of trend following across different asset classes. And we're measuring it with something called the Sharpe ratio, which is basically just a fancy way of saying, how much bang do you get for your buck risk-wise? Higher is better. And if you look all the way to the left, well, there's the equity sector, sitting in dead last. It's delivering the worst risk-adjusted returns of the entire bunch. And this next chart tells us why that is. It shows the chances of a strong, profitable trend actually showing up in each of these sectors. And again, look at equities, right there at the bottom. This tells us that, compared to something like bonds or currencies, those nice, clean, rideable trends are just a lot harder to come by in the stock market. So the returns are weaker because the opportunities themselves are just not as common. Now, if you're a fund manager and you're staring at this data, a very logical, almost painfully obvious solution probably jumps right into your head. I mean, if one part of your system is always lagging behind, why wouldn't you try to fix it? And as you dig in, the data shows that most of this underperformance is coming from the short side of the trades, the bets that stocks are going to go down. So the natural question is, if shorting stocks is a losing game for the strategy, why not just stop doing it? Why not focus only on the long trades, the bets that stocks are going to go up? And, well, when you actually test that idea, the results look absolutely fantastic. The red line here is the standard system, with both long and short trades. The green line, that's just the short trades, and yeah, it's a total disaster. But look at that blue line. That's the long-only system. The performance is just massively better. It's not even close. And the numbers here back that up 100%. By just switching to a long-only approach for stocks, the monthly return jumps from 0.8% to over 1.3%. And the Sharpe ratio gets better too. It honestly looks like an open and shut case. We found the problem, we cut it out, and we made the system better, right? The strategy now looks way better on its own. It's got higher returns, a better risk profile. From a manager's point of view, this is an easy story to sell. You've optimized the system. But, and this is a huge but, this optimization comes at a staggering hidden cost. Okay, so up to this point, we've only been looking at how this equity strategy performs all by itself in a vacuum. But what happens to the portfolio's most important feature, its crisis alpha, when we make this supposed improvement? And this slide right here reveals the whole trade-off. In blue, you've got the original system, and in red, our new improved version. Now, just like we expected, the total return goes up a little bit. But then, look at the crisis alpha. It absolutely plummets. It goes from almost 5% all the way down to basically zero. It's gone. In our effort to fix the strategy, we've pretty much eliminated its entire superpower. So remember those unprofitable short equity trades we just got rid of?
Well, it turns out they were the very engine of the strategy's crisis alpha. They were the exact positions that make money when the stock market is crashing. By optimizing them away to make the day-to-day performance look a little better, we've basically told our portfolio's firefighter to leave the heavy water hose at the station because it slows him down on sunny days.
And this all leads to a really critical question. See, when you're building a portfolio, you're not trying to make every single piece look perfect on its own. You're trying to build a resilient team that works together, especially when the pressure's on.
This is really where the rubber meets the road. Let's look at a standard 60-40 stock and bond portfolio. All by itself, its worst loss, its max drawdown, was almost 45%. Ouch. Now, adding our improved strategy does help. It reduces that loss down to about 27.5%. But look what happens when we add the original, unoptimized system, the one with all those supposedly bad short trades. The max drawdown gets cut to under 25%, and the whole portfolio's risk-adjusted return, its Sharpe ratio, is the highest of them all. The worst strategy created a much better portfolio.
And that right there is the key takeaway from this whole thing. True diversification isn't about packing your portfolio with a bunch of things that all go up at the same time. It's about including some things that are specifically designed to do well when everything else is failing. That drag from those short equity positions during the good times, well, that's the price you pay for the powerful protection they give you during a crisis. And that brings us to one final, really provocative thought from the source material. A manager might be tempted to make this improvement because, frankly, it makes their standalone product look better on a chart and makes it easier to sell. But for you, the end investor who actually cares about how your entire portfolio performs, that seemingly smart fix could be a devastating mistake. It's a powerful reminder to always ask yourself, what is the real job of this investment in my portfolio? And what am I secretly giving up just to make it look prettier on paper?
Hey, welcome to The Explainer. You know, we've all heard that classic line, bigger is better. And in the world of investing, it's easy to think a fund with billions of dollars under its belt is the safest, smartest bet. But what if that massive size is actually a hidden weakness? Today, we're going to dig into some fascinating analysis that flips that whole idea on its head. So let's just get right to it with this question. When you see a fund managing billions, do you automatically think it's superior to a smaller one? Look, it's a totally natural assumption to make. But the data we're about to walk through suggests the answer is, well, it's a lot more complicated than you might think. And to make this all super clear, we're going to lean on one simple analogy for this whole explainer. I want you to think of those huge, massive funds as giant cargo ships, and the smaller funds, they're nimble little speedboats. Seriously, keep this picture in your head because it perfectly captures the trade-offs we're about to talk about. All right, first up, let's dive into what we're calling the billion-dollar paradox. This is where a fund's greatest strength, all that money, starts to become its biggest headache. And here's the crucial idea, the core of the whole thing. As a fund gets more and more money, it literally becomes a victim of its own success. You know, the very strategies that made it a winner in the first place, they get harder and sometimes flat out impossible to pull off when you're working at a massive scale. And that brings us right to the problem of the cargo ship just getting too big, too clumsy to be nimble. Okay, so this is where our analogy really starts to pay off. A giant cargo ship, our billion-dollar fund, can only dock in the world's biggest, deepest ports. It can't just zip into a tiny secluded cove, right? In investing terms, that means it's stuck playing in the largest, most liquid markets. Think major currencies, big company stocks. And it has to move slowly, deliberately, so it doesn't create huge waves and disrupt the whole market. But the speedboat, our smaller fund, it has none of those problems. It can explore all those little coves, the niche, less liquid markets. And it can turn on a dime, reacting to new info in a flash. Now, that ability to access all those different markets is absolutely key to unlocking one of the most powerful concepts in all of finance, diversification. People call it the only free lunch for a reason. It's the most reliable way to lower your risk without having to give up your returns. The whole trick is to own a bunch of things that don't all go up or down at the exact same time. And this chart shows you exactly why that works. Over on the left, you've got assets with low correlation. They kind of dance to their own beat. When you mix those together, your diversification benefit is super high and your portfolio has a much, much smoother ride. But as you move over to the right, your assets get more correlated. They all move in lockstep, and that beautiful benefit just vanishes. The goal is to find assets that live on the left side of this chart. So where do we find these golden low correlation assets? Well, just look at this table.
Back in 2012, agricultural markets, think things like corn or cattle, had an unbelievably low correlation of just 3.7% with other sectors. Now compare that to equities or currencies. These are the exact kind of diversifying coves that a speedboat fund can go explore. But a massive cargo ship fund? No way. It simply can't get in there in any meaningful way. A single trade from a fund that size would be the whole market.
Okay, so that's the theory. But what's the actual real-world impact? Let's look at the hard evidence for how these big funds can start losing the magic touch.
And yeah, it's a big deal. This chart is really telling. It shows what happens to a fund's own internal diversification as its assets, its AUM, gets bigger and bigger. By the time a fund hits $25 billion, its ability to diversify its own holdings has dropped by a staggering 30%. It's being forced out of all those valuable niche markets and into the same crowded, highly correlated ones everyone else is in.
Now, one of the main reasons people invest in these kinds of strategies is for something called crisis alpha. Honestly, you should think of it like a portfolio superpower. It's the ability to actually perform well, to even make money when traditional markets, like stocks, are in a complete freefall. It is the ultimate form of protection.
But just look what happens to that superpower as a fund gets bigger. This chart is so important. A fund with $25 billion has nearly 25% less crisis alpha than a $1 billion fund. The very protection that investors are paying for is getting weaker and weaker simply because the fund got too big.
So, if being a giant cargo ship is the problem, what's the solution? Well, it all comes back to the speedboat's big advantage, the power of niche markets.
This quote, straight from the source material, just lays it all out perfectly. Getting into those less traveled markets isn't just a cool trick. It leads to real, measurable improvements across the board. We're talking better risk-adjusted returns, smaller losses when things go bad, and more of that absolutely critical crisis protection. Let's look at the proof, piece by piece. First, the payoff. You get a higher Sharpe ratio, which is just a fancy way of measuring how much return you get for the amount of risk you take. It's your bang for your buck. And as this chart shows, when a portfolio includes more of these niche markets, that risk-adjusted performance just keeps getting better.
Second, the protection. This chart shows the maximum drawdown, which is the biggest loss a portfolio took from its highest point. And get this, the portfolio that could only invest in the big liquid markets, it lost almost 50% at one point. The fully diversified one that could go everywhere, its worst loss was way smaller, around 32%. I mean, that's a massive difference when your money's on the line.
And finally, the superpower comes roaring back. Crisis alpha is at its absolute strongest, its most potent, when the full universe of markets, all those niche, less liquid ones included, is in the mix. This is how a fund gets its protective edge back, by being a nimble speedboat that can trade everywhere, not just in the crowded main ports.
So let's bring this all home. What's the big takeaway for you as an investor? How can you actually use this information to make smarter choices? So let's just quickly recap what we've learned. It's a pretty clear story, right? Getting bigger forces a fund to be less nimble, like a cargo ship. That means they have to abandon those small, really powerful diversifying markets. And that in turn hurts their internal diversification and weakens their crisis protection. Meanwhile, the smaller, more agile speedboat funds can access these niche markets, which can lead to better risk-adjusted returns and much better protection during those market storms.
So I'm going to leave you with this final thought. The next time you're looking at an investment fund, try not to be immediately impressed by all the zeros in its asset number. The most important question might not be how big is it, but rather how nimble is it? And that little shift in perspective, well, it could make all the difference for your portfolio. Thanks for joining us.
All right, let's talk about an idea that sounds, well, just plain wrong at first. Diversifying the diversifier. We're always told that more diversification is the holy grail, right? But what if taking a great diversifier and trying to make it even better actually makes your whole portfolio weaker? Let's get into it. So let's just start with this question right here. We all want our investments to be better, smoother, more diversified, the whole package. But is what makes a single investment look great in a vacuum really what's best for your entire portfolio? That's the paradox we're going to unpack today. And at the center of this story, we've got two main characters. On one side, you have pure trend following.
Think of this as the specialist. It's got one mission: catch the big market waves, no matter if they're going up or crashing down. And then on the other side, you've got the multi-strategy approach. This is the generalist. It takes that specialist trend follower and starts mixing in a bunch of other strategies, trying to create something that feels a bit safer and smoother.
So you have to ask, right? Why would a fund manager take this pure specialist strategy and start tinkering with it? Well, it all comes down to the powerful allure of making something look better on paper. There's a big trend right now of managers shifting away from these pure strategies and towards these multi-strategy funds. And the thinking behind it seems totally logical, right? They want to create a product that's less bumpy, more stable, and really pump up a key number that they know investors pay a lot of attention to. And that key number, that metric, leads us straight into what we're going to call the Sharpe ratio trap. It's the number one tool most people use to judge an investment, but man, can it be misleading. So what exactly is the Sharpe ratio? You can just think of it as a report card for your investment. It answers the question, how much bang am I getting for my buck? How much return are you getting for the amount of risk you're taking on? And for decades, the rule has been dead simple. The higher the number, the better the investment. It's the gold star everyone chases.
Now, this is where it gets really interesting because this chart shows you exactly why managers are so tempted to do this. I mean, look at this. When you judge these strategies all by themselves, the evidence looks totally overwhelming. The multi-strategy approach, that blue line, consistently has a higher, better Sharpe ratio than the pure trend follower in red. You'd look at this and think, case closed, right? The multi-strategy fund is just better.
But not so fast, because as it turns out, a high Sharpe ratio can be a bit of a mirage. It often papers over hidden risks and tells a story that's maybe a little too perfect, a little too good to be true. And this is where we get to the big reveal. Because it turns out that pure trend following has some, for lack of a better term, hidden superpowers. These are incredibly valuable traits that just don't get picked up by a simple score like the Sharpe ratio.
Which leads us to the most important question of all. In the quest to get that higher Sharpe ratio, to make that one fund look prettier all by itself, what is actually being sacrificed? What's getting watered down or even destroyed in this process of improving it?
Okay, superpower number one is something called positive skewness. The absolute easiest way to think about this is like a lottery ticket. It means your investment has a much, much higher chance of a rare massive win than it does of a rare massive loss. It's built for huge positive surprises. Most investments, they're the exact opposite. They're prone to those sudden nasty surprises on the downside. And this chart just perfectly illustrates how rare that is. Look way over on the left. That big green bar, that's pure trend following with its awesome positive skewness. Now scan your eyes across to the right. See all that? Almost every other strategy is negatively skewed. They're more like selling lottery tickets than buying them. So when you start mixing those into your trend follower, you're basically killing this superpower.
Superpower number 2 is called crisis alpha. And this one is huge. This is the rare ability of an investment to actually make money when everything else in the world is on fire. It's the firefighter in your portfolio. While everyone else is running away from the danger, this is the one thing that runs toward it to help you out.
And wow, this visual is just stunning. Again, on the far left, you see pure trend following delivering huge positive returns right in the middle of a market crisis. Now look at all the others. Just like with skewness, almost every single one of them loses money. This proves it's not just a diversifier, it's a protector. And mixing in other strategies, that's like telling your firefighter to take the day off during a 5-alarm fire. So, okay, we have these two amazing superpowers, positive skewness and crisis alpha. But what does that actually do for you, for your portfolio in the real world? Well, let's see how they combine to create the ultimate safety net. This chart shows a classic 60-40 portfolio during the 2008 financial crisis. We all remember that one. Now look what happened. The portfolio that added the better multi-strategy fund, that's the red line, it still got hammered. But look at the blue line. The portfolio with the pure trend follower didn't just survive the crash, it actually spiked upward, acting like a giant shock absorber right when you needed it the most.
And this really just brings us to the heart of the whole thing. The very act of trying to diversify the diversifier, of trying to make it look smoother, is what directly dilutes its most important job, protecting your main portfolio. And if you want to see the proof, well, here it is in black and white. That bar on the far left,
That's a 100% pure trend-following strategy added to a portfolio. See how high it is? That's its power to reduce your portfolio's worst-case loss, what we call a drawdown. Now, just move your eyes to the right. As you start mixing in more and more of those other strategies, look at what happens. That protective power just absolutely collapses.
I mean, the difference here is just staggering. A pure strategy has 2.5 times the drawdown reducing power of a strategy that's been diluted just 50-50. That is a massive amount of protection to just throw away, all to make one little piece of your portfolio look a bit smoother on its own.
So let's bring this all home. Let's be crystal clear about what an investor really truly loses when their diversifier gets diversified.
So here's the core trade-off, plain and simple. Yeah, the multi-strategy fund looks great on its own. It's got that high Sharpe ratio. It looks stable. But to get that, you sacrifice the very superpowers that make it valuable to your whole portfolio. You lose that lottery ticket upside. And way more importantly, you lose that firefighter protection when things get ugly.
And this brings us to the final and I think most critical takeaway. It's like baking a cake, right? You can't judge each ingredient by itself. Sure, a cup of flour on its own is boring and dry, but you absolutely need it for the final cake to work. That specialist pure trend following might look a little wild on its own, but its unique role is exactly what makes the entire portfolio recipe so much stronger and safer.
So, we'll leave you with this one question to think about. When you look at your own investments, particularly the ones you're counting on to be your diversifiers, ask yourself, is this fund built to look good on its own report card? Or is it built to do its real job for my entire portfolio when I need it most? The answer might just surprise you. Thanks for tuning in.
All right, let's talk about trend following. It's a dynamic strategy, right? So that brings up a really tricky question. Should you also be dynamic in how you allocate to it? I mean, how do you time your investment in a strategy that's, well, all about timing? That's exactly what we're going to dig into.
Okay, picture this. You've got your trend-following strategy, and suddenly, it's in a drawdown. What's your gut screaming at you to do? Sell, right? Get out before it gets any worse. It feels like the right move, the smart, defensive play. But here's the thing. When it comes to trend following, your gut could be leading you straight into a trap. Let's find out why.
So, the big question is, how do you time a timer? It sounds a little meta, I know, but basically there are 3 main ways to think about this. And the best approach? Well, it all comes down to how the returns of the strategy actually behave over time.
And this right here, this framework lays it all out. Your strategy depends completely on how the returns act. Think about it. If they have momentum, well, you chase performance. If they're totally random, you just buy and hold. But what if they're mean reverting? You know, where a good run is often followed by a bad one and a bad one by a good one. In that case, buying the dips is the smartest play.
All right, let's dive into the most common, most intuitive thing we all do as investors, chasing performance. It just feels right, doesn't it? But as we're about to find out, when it comes to trend following, feelings can be very, very deceiving.
So what is momentum seeking? It's exactly what it sounds like. You see something doing well, you pile in. It starts doing poorly, you bail. It's basically the financial version of jumping on the bandwagon.
And you see this play out in the real world all the time. Just look at 2008. It was a massive year for trend following, right? So what happened in 2009? A huge flood of new money poured in, everyone expecting the good times to keep rolling. That is textbook performance chasing. So the big question, does this actually work? Well, the data is pretty brutal. The answer is a hard no. What you're looking at here is a test of something called trend following squared, which is a fancy way of saying they applied a trend strategy to a trend fund. That green shield, that's our baseline, a simple buy and hold approach, with a really solid Sharpe ratio of 0.94. Now look at all those blue bars. See how none of them, not a single one, ever gets as high as the green shield? The message is crystal clear. Chasing performance consistently makes things worse.
Okay, so if our gut instinct to chase performance is totally wrong, then what's really going on here? The answer is hiding in the data, in a specific statistical property of trend following returns. And let me tell you, it's the opposite of what you'd expect.
So let's just think this through for a second. If chasing performance, a momentum strategy, doesn't work, what does that tell us? It's a huge clue that the returns themselves don't have momentum, and that leads us to a really important idea.
This is the magic term right here, serial autocorrelation. It sounds complicated, but it's not. All it does is measure if there's a pattern between returns from, say, this month and next month. If it's positive, that's momentum. Good returns tend to be followed by more good returns. But if it's negative, that's mean reversion. A good month makes a bad month more likely. And wow, this chart just lays it all out. It shows the serial autocorrelation for a whole bunch of different hedge fund strategies. See how almost all of them are positive? They have momentum. But then, look all the way over to the right. The two trend-following indexes, they're the only ones with statistically significant negative serial autocorrelation. That, right there, is the smoking gun. This explains everything.
So let's just put that in simple terms. What this means is the trend-following returns tend to mean revert. A great period of performance makes a bad period more likely to come next. And, just as importantly, a drawdown makes a recovery more likely. It's the complete opposite of momentum.
Okay, so now we know this huge secret, right? Trend-following returns mean revert. And once you understand that, a completely different and, frankly, much smarter strategy comes into focus.
And that strategy is buying the dips. It's the polar opposite of chasing performance. Instead of selling when things are down, you actually buy more. You lean into the drawdown because you're betting that mean reversion is going to kick in and performance will snap back to its long-term average. It's the classic be greedy when others are fearful idea.
And guess what? The data totally backs this up. This chart is awesome. It shows what happens when you mix a regular buy and hold approach with buying the dips. See over on the far right? That's 100% buy and hold, our baseline Sharp. Now, as you move to the left and start dedicating more of your portfolio to buying those dips, look what happens. The risk-adjusted returns just keep getting better.
But wait, it's not quite that simple. The decision isn't just about mean reversion. There's another really important piece of the puzzle we have to look at, and that's the overall quality of the strategy itself. So there are really two key factors you got to look at. First is that serial autocorrelation we just talked about, and the second is the strategy's long-term Sharpe ratio. You have to consider both things, how returns behave from one period to the next, and how good the strategy is overall.
This little table here puts it all together perfectly. Look at the top row. If you have a high-quality strategy, but its returns are basically random, what do? Simple, buy and hold. But now check out that second row. For a strategy with that strong negative autocorrelation we found in trend following, buying the dips is the way to go, especially if the strategy's overall performance is a little lower.
And these two charts really drive the point home. Look at the one on the left. This is a world where the strategy has a high Sharpe ratio. It performs really well. In that case, adding a buy the dips component actually hurts your returns. But now look at the chart on the right. In a low Sharpe ratio world, that same exact buy the dip strategy gives your returns a major boost. See? Context is everything.
So, what does all this mean for you, the investor? Let's boil this all down into a clear, actionable plan.
Okay, here are the big takeaways. Number one, and this is the most important one, stop chasing performance and trend following. Just stop. The data is clear, it is a losing game. The best way to do it is with a smart blend. A core buy and hold position mixed with a tactical plan to buy the dips when they happen.
So here's a simple way to put this into practice. If you're super confident in the long-term performance, you think it has a high Sharpe ratio, then just buy and hold. Easy. But if you're a little less confident, then maybe you set up a baseline holding of, say, 50 to 75%, and you keep that other 25 to 50% as dry powder, ready to deploy and buy the dips when those drawdowns inevitably come along.
And look, if you only remember one thing from all this, make it this quote from the author of the research, Dr. Alex Greyserman. Performance chasing is not compatible with the mean reverting nature of trend-following returns. It just doesn't work. The very nature of the strategy is working against you.
So let me leave you with this. The next time you see your trend-following strategy in a drawdown, and that little voice in your head, your gut, is telling you to sell, what are you going to do? Are you going to listen to your gut, or are you going to listen to the data? That's the billion-dollar question, isn't it?